Okay, folks, welcome back. This is our weekend review and commentary for the ICT Mentorship week ending February 5th, 2021. General commentary on our usual suspects here with the dollar index, euro dollar, pound dollar. Price action lesson for this week is redelivered rebalance. All right, for the economic calendar, I have every currency pair except Swiss and yen considered. So this is what we have for Monday: New Zealand dollar medium impact inflation expectations. Tuesday, absence of any real economic drivers. Wednesday, 8:30 a.m., New York session CPI for dollar medium impact. 10:30 a.m., medium impact crude oil inventories. That usually is influential for Canadian dollar. So your Canadian crosses and or dollar CAD pair, you might want to study on Wednesday with that. On noon Wednesday, GBP high impact speaker, and 2 p.m. Fed Chair Powell speaks, so there'll probably be some volatility late in the day on Wednesday as a result of that. Thursday, London Open 5 a.m. medium impact euro economic forecasts. 8:30 a.m. Thursday, New York session, medium impact dollar-based unemployment claims. And then Friday, London Open 2 a.m. GBP, medium impact preliminary GDP. All right, so we're starting with the dollar index monthly chart. Pause the video if you're not ready. All right, so here we have the fair value gap that I've outlined weeks ago, and we finally closed that in. So we have met the minimum threshold for potential continuation on the downside. So what am I saying here? I think going forward, we should study the likelihood of dollar moving lower and maybe even making an attempt to eventually get down to that sell side liquidity pool. Nothing looks strong for the dollar. In fact, it looks rather weak. And all this may have been was simply just a short-term little retracement and an overall strong decline 4 months ago and 3 months ago. Weekly chart for dollar index. If you're not ready, pause your video. All right, so here we have the market trading above into the premium levels that I've outlined. And at one point, and I, unfortunately, with everything going on with the administration side of the mentorship, I was unable to get a screenshot of this candle being bold-face green. Because at some point, this was all full-on, straight up, big green candle. Okay, so this expansion is the heart of how I teach my mentorship. We're worried about only one thing, okay? Understanding where the draw on liquidity is going to be. Everything else after that is easy, but you have to know this part, okay? If you don't know where the market's likely to be pulled to, okay, or as I describe it, drawn to for liquidity purposes, you're going to struggle. Everything you try to push into your charts is going to be in vain. It's going to be a struggle. It's very pleasing for me as a mentor to start the group off. It just came in with this level of prognostication, because there are going to be times when you go through this mentorship with me where I don't know and I have to sit and wait, and that might be a little unnerving for you. But now you have a taste. With 1 full week of the real mentorship, you've had a taste of it now. Not every single week is going to be like this. It's not going to be me pointing and it delivers. It's going to be a lot of teaching, because there's a lot of teachings I have to get through. Okay, so I don't have all the time in the world to be doing lessons every single day. And in fact, you will never get caught up because you have families and you have businesses and you have jobs and you have school, all the things in your personal life. So you have that small little time in a day where you're trying to allocate learning. And many of you are trying to cram all of this content into that little tiny window of opportunity per day. Even though I said not to do that. You have to slow down, okay? It will come, but you have to go slow, all right? But just as a reminder, just know that now that you've seen what it's like and what you learn here, while I'm not completely moving away from calling where the market's going to go, I do have to next week start putting in a lot more teachings. Okay, so we spoke predominantly on the likelihood of the dollar index reaching up into these levels, and now that it has done that, I'm going to give you my opinion of what it might try to do. I might be wrong, but I'm going to go with this direction going forward until proven incorrect. All right, so the high and the low, respectively, that was our dealing range. That equilibrium level here, or if you ran a fib from this high to that low, that's 50%. So we want to see it trade to that and preferably above it before we would be bearish on dollar. And here is the weekly fair value gap, high of that candle and low of that candle. And then we have these levels here, which is the optimal trade entry. And that's really what I was trying to favor. I wanted to see it get up in the optimal trade entry and at least midpoint of the gap. Okay, so the fair value gap here and here, it went to a level beyond consequent encroachment. So we went above midpoint of that and into optimal trade entry. And look at the reaction we had this Friday. It's just been really quick to give back a lot of that. That's what you want to see. If you see a weak market, or you assume the market's weak, you want to see these types of reactions at your premium arrays. Premium arrays are anything like a bearish order block, a bearish breaker, a bearish fair value gap, a bearish mitigation block, an old high above equilibrium inside of your determined price range. Okay, so this being our dealing range, we're working within this range. All this stuff over here is of no concern to me. What I've done over the past few weeks and month is put your attention on what the algorithm is going to be referring to. And that's this candle's high and this candle's low. And that's the dealing range. You learn more about that throughout the core content. So each month you learn a little bit more that you won't feel is important to this real life example that I've outlined and walked forward with you each day. But it's supportive. So everything that you're learning in these core content lessons, they're adding understanding that's going to be required to lean on to build what you just watched me do over the last month or so. So it's not just what month do you teach dealing ranges, which month do you teach premium and discount. Everything has to be considered. Okay. And I gave the analogy on my community tab where on my YouTube channel where I drew on the analogy of being a doctor and a surgeon, and they go through a lot of prerequisite courses and they have to understand a lot of things about anatomy, even though they may be aiming for a specialty in brain surgery. They have to learn a lot about, the skin, the connective tissues, membranes, the vascular system, nervous system. All these things have to be learned because they're supportive and detrimental to the outcome if they're not considered. So this is no different. It's highly technical, and you just watched me use the things I teach you. And if this doesn't get you going, if it doesn't give you confidence, if it doesn't show you that there's things outside of retail that really work and it's algorithmic, then there's nothing else I have in here. There's nothing else except for what you see me do on YouTube. There's a rhyme and reason why these things happen, but you have to wait for specific signatures in the marketplace to present themselves. Otherwise, you're gambling, and I don't gamble. So that was the little bit of a rant. So we're going to go into the daily chart now. All right, here's your daily chart on the dollar. If you're not ready, pause the video. Okay, so the optimal trade entry and fair value gap levels, premium levels, defining that. We won't have this on the chart anymore after this week, and the volume imbalance is no longer salient for now because we've already consumed that. This candle's action right here for Friday, I really like that. I like the fact that we had a nice reaction at the optimal trade entry level here, and what this level is 62%, and this is 79% relative to the high and low on running a fib between these two levels here, pulling your fib from the high down to the low, 62, 79% retracement respectively. And then this is those weekly levels they outlined on the weekly chart for the fair value gap. Outline the bullish order blocks in here so you can see how they stepped the market higher, and now we have this. So what we're looking for is a sharp continuation of weakness on the dollar going into next week. The absence of any real economic drivers on the economic calendar is kind of like if you were in traffic, okay, and you were the first car in the front and everybody behind you was really the congestion. We have really nothing in front of us until around Wednesday where it could impede the ability for dollar to make a nice run lower. If we get to the point where we take out this swing low here, things can tend to get a little accelerated, meaning it could go below here, trade it to some kind of maybe fair value gap or bearish order block or mitigation block, and then it could really start to see large candles on the downside to attack this low in here. And then we'll see what we get, going into Sunday's opening and Monday's trading. All right, hourly chart on dollar. Pause the video if you're not ready. All right, between the fair value gap premium high and fair value gap discount low, that's what these levels are here and here. The midpoint of that is consequent encroachment, and that's basically what you're seeing the market reach up into, and it's also reaching into that optimal trade entry from that daily range, or dealing range, I should say. So we traded up into it, had a small little pool of liquidity, traded above that, broke down, created a fair value gap in here, and consequent encroachment. So it's this candle right here goes right to the midpoint of this level and this level. Find the 50% on a fib, draw that out in time, and that's what it hits right here. So I'm showing the fair value gap and consequent encroachment of this fair value gap. That's what's being annotated there. Also inside the optimal trade entry levels. This is a breaker. You'll see it more clear when we get into the 15-minute time frame, but buy side liquidity had a nice effect on drawing price up into these levels, and then we have quickly gave up the ghost. On Wednesday, the levels I gave you for the daily log entry, go back and look at those and you'll see this fair value gap and the action there. Okay, just beautiful response and price that is just perfect. It's just perfect. No support resistance ideas that lends well to that. It's just right out of the book of ICT. So right now we went back to that premium discount line. Okay, in other words, this is the equilibrium line on that dealing range relative to the daily chart. So we're right back to quote unquote equilibrium. It can go either direction from here, but look how we've traded here. Okay, it looks really heavy. I like the idea of it trading down into the fair value gap over here. So we'll see if that is the case going forward into next week. It may require Wednesday's trading to start it, but if it's heavy going into Sunday's opening and or trading in Monday, then my focus is here for dollar. 15-minute time frame for the dollar index. Pause your video if you're not ready. All right, so same thing we saw on the hourly chart, just a little bit more detail with the breakers. So we have a bearish breaker, fair value gap, sell side imbalance, buy side inefficiency, trades up into an optimal trade entry, and mean threshold of the breaker. Both of these down close candles prior to this run up clearing these highs This is your breaker. Okay. If you're new here in month 1 and you don't really know what a breaker is, I teach that in month 4. So just, kind of hold off and trust that I will get to it. And then also there's lots of supportive commentaries and lessons throughout the core content, and then it just builds on it. Market breaks down, creates a little fair value gap in here, trades up into the optimal trade entry level. See that? So optimal trade entry here, smaller, and hitting the daily dealing range optimal trade entry level, which is this dashed line here, and breaks down after hitting the last 2 up close candles, which is the bearish order block. The displacement here sets the stage for that being sensitive, and we have multiple things providing a multi-layered view of premium arrays that could have been used for this sell-off. Plus, it's non-farm payroll Friday's news driver, so that's what you're seeing here. The market drops down, goes right through the fair value gap here. So that's what you want to see. You want to see discount arrays, things that would act as support, being broken. Not just simply, oh, here's an old turning point and it broke. No, we're looking at it in the scope of it's a PD array. The imbalance was the nature of this rally up, not some kind of old low or old high being drawn to and then bouncing off of it. And again, as I mentioned, we're at fair value in the sense that we're in the midpoint of that daily dealing range or at equilibrium. All right, here's the euro dollar monthly chart. Pause the video if you're not ready. All right, so we have a bullish order block here, and we traded down into basically the consequent encroachment of this wick. Now a wick is a gap. This is the body, and a tail is also a gap. That's how I teach it. The midpoint of the open to high on this little tiny little wick, we split that in half, and that's consequent encroachment. It went just below that, but that's a sensitive price level nonetheless. This is where I think we could potentially trade to if we see a continuation lower on dollar, and euro could find its way above here. Now there is the rejection block, which is this high in here, that may be a draw on liquidity and not necessarily get above this high, but we have this high to get through first, so that's why I'm not really dressing all this up here, because I don't want to sell the idea too hard. Weekly chart on euro dollar. Take a look at this and pause the video if you're not ready. Okay, and there's the weekly fair value gap. Beautiful delivery of that. And again, these are levels that you've known about for several weeks now. And ultimately, like I said, I think that this could be a draw on liquidity, and I'm going to frame it with that in mind. If we take out this candle's low, in other words, this little tiny indifferent down close candle, if we take out the low of that, then I'm not bullish on euro. So it gives me a lot of room to see what this pair will do, because I'm not trying to be as precise right now. I want to see what we can find in terms of a new range. Euro dollar on the daily chart. Pause the video if you're not ready. All right, so we had initially 2 fair value gaps that were outlined here and here. And I gave you the framework before we started trading this week that if we gap down on dollar, that would mean one thing. If it gapped up on dollar, that would mean another thing. And I'm not going to repeat all that because I've already said it. And if you didn't watch the video or even know what I'm referring to, go back and watch the last 2 videos. Okay, not the daily log entries, but the midweek review on Wednesday and last Sunday's video. That's what I'm referring to. So this fair value gap, we obviously went to and through, and then hit the order block that I also had outlined. And look at the reaction here. Just stunning. Look at the bodies respecting the order block. Perfect. Like, this is the stuff you're wanting to see with support and resistance. You just don't get it all the time. Most of the time, in fact. So we have a little bit of an imbalance in here. That might be the draw on the beginning of the week. So if it trades up into that, say going into Powell speaking on like whenever it was in the week, if it trades up into that, we might get a reaction and sell off a little bit, maybe pick up some orders here at this order block. That's something I would watch. I'm not trying to prognosticate too many things because, again, it's the weekend. I don't know how we're going to open up on the Sunday, so that's an unknown thing for me. So I have to watch and see what we do. But some of the scenarios I would like to see is this being drawn to in the first half of the week. And then if we trade through it and trade back down on PAL speaking, I might use this as an area to go long with an idea that sends us up into this fair value gap. So long story short, unless we take out Friday's low, I'm thinking right here. Now, why do I feel this? Well, if you look at this low up to this high, we've traded all the way down to a discount relative to this high and this low, and 50% is about right in here, roughly eyeballing it. And the specific discount arrays that I gave you ahead of time was this down close candle, which is a bullish order block with the fair value gap, and we had a nice reaction here on non-farm payroll. Now, if this would have been non-farm payroll last week and normal trading, I would have traded today on a Friday, and I would have liked to believe I would have had some of this range. It sounds a little funny me talking like that, but hopefully I've earned the right to be able to say that. Euro dollar 1 hour chart. Pause the video if you're not ready. So there's that fair value gap in here. We have a small little imbalance. I'm not going to concern myself with that right now because we just made our way up to this area here for buy side liquidity. Hasn't really quite purged it yet for my liking, but we have to consider that first. And then we have a fair value gap in here. So we could see it trade down and still be fine. It wouldn't necessarily break the underlying bullishness that I'm trying to strive for throughout this week and maybe in the following week for euro dollar. Bullish order block, fair value gap that doesn't have the annotations there because we already got too much going on here with the order blocks. But watch this in here. Should we start to sell off a little bit, that might be something to watch for bullishness. Traded into the order block, that shaded area, and you can see how nice that was. So bullish breaker, last up close candle, draw that out in time. You see the sensitivity there as well. So there's a lot of things acting together for support ideas at a discount, which coupled with the unemployment number, which if you look at the unemployment data, at least from Forex Factory, I don't look at the raw numbers of any of these reports. I just anticipate the volatility that they may bring into the marketplace. So if you look at the way they internalize what the outcome should be for the currencies with these things that released as reports and such, the forecasted number for unemployment actually became a better number at the time of release than that of what was forecasted. So generally, it's interpreted that if the number is better than forecasted, that's good for the currency. So what employment numbers came out today at 8:30 in the morning New York time? U.S. employment, non-farm payroll numbers. So the number came out better than forecasted, but the dollar tanked. So you can see, I don't care what those numbers are. I'm waiting for the volatility. And there's a lot of people that write courses and books and make all these seminars and such, and they try to sell you on the idea that you can read the tea leaves with these minute by minute market releases that come out. And sometimes, yeah, but not to the point where it would sell me on the idea that that's what I should be doing versus what I do. You know, I am a firm believer that those numbers are of no consequence. Over a period of time, the trend of those numbers are more meaningful. But you know, every single month release at a time, to me, that doesn't mean not all that much. And it was explained to me in all the books I've ever read that what we witnessed today was it was already priced into the marketplace because the talking heads have to have an excuse to explain away why their logic doesn't work. So right away, okay, well, it was priced in. Why weren't you talking about it being priced in before the number? So just contrast that with what we were anticipating, where the dollar drew up into, and then how it's reacted. And we just used the volatility of non-farm payroll to feed that fire. Now, I'm not saying we were right about anything except for it has seen a draw in liquidity up into that weekly fair value gap and optimal trade entry for the daily chart on the dollar. I'm only hanging my hat on that. But today's reaction was fueled by the employment number and the data that came out. Normally when traders see that, they want to be buying dollar and shorting foreign currency. And they got served today. And we're going to go to 15-minute time frame on euro dollar. If you're not ready, pause your video. All right, so here we have, again, better view of the order blocks. The fair value gap came down beyond consequent encroachment. You can see the breaker reaction there. Runs up. Nice little optimal trend entry, and this is a down close candle. So that is a order block with a fair value gap. Then you have this expansion here. Small little fair value gap right here. And I used the shaded rectangle just so you can see the contrast between these levels here and here, because otherwise it might have been a little confusing, because it was, as I was drawing it out, I said, you know what, the new students aren't going to be able to see this as clearly as I want them to be able to see it. But this is a fair value gap. Also, we'll talk about this, how it's a fair value gap, because right away you're thinking, how's that a fair value gap? There's no gap there. There is, and I'll explain to you in a little bit. That's the nature of this lesson today. Also, real quick before I get into it, if your charts don't say forex.com when you're using TradingView up in the upper left hand corner, it might say something else like Saxo, or it might say FXCM. If yours look like that, your charts are never going to agree with mine. And I had a couple students email me and say, hey, my charts don't have the fair value gap that you have. My charts don't look the same as yours. When you type in euro dollar, okay, EURUSD in your selection field for TradingView, as soon as you put that in, stop. Don't just hit the USD in the name of the pair and then hit enter, because this is going to pull up the default. And it might not be defaulted to forex.com. So you just put in euro USD or EURUSD in TradingView's symbol field, but don't hit enter. And then what'll happen is it'll give you a pop-up menu with various different price feeds to pull from. You look for this one, forex.com, and you can click on that, and then your charts will look exactly like mine. Okay. All right. So a small little fair value gap there as well. Didn't quite really run through the buy-side liquidity pool to my liking yet. We still have the upper end of that fair value gap here to try to get to and through. So we'll see what happens there. But if we have any kind of retracements, it needs to bounce here. In other words, if it comes down here, it needs to be strongly bullish from that one. It can meander down to this one, give, just the top end of that, and that would be fine too. The reason why I'm saying that is because if you look at this low up to, I'm assuming it runs above the fair value gap premium high. That's what this is here. So if it trades to that or a little bit above it and comes back down, this would be basically like an optimal trade entry. So it doesn't need to completely close all this in. And I know I'm tripping you up right now because you don't see what you classify as a fair value gap by my previous teachings, which is clearly seen here. One candle. Here we have a run and then run again. So how's that a fair value gap? I'll teach it to you. But it could drop down to this one, and if we get sensitivity there, that'd be nice, because it would just bode well for near-term bullishness and not really need to come down to these levels at all. All right, British pound versus US dollar. This is the monthly chart. I'm just going to go right into this one because you're not going to look for anything in this because it's really framed on the weekly chart. So those levels right here are going to be seen more clearly on weekly. So we're going to go to that next. All right, and you should be able to see the imbalance that resides in this chart now. All right, so those same levels I was showing on the monthly chart are here. So we have a little bit of an imbalance there. We do have the breaker, so I am watching this last down close candle. It might just trade up into that a little bit more, and we might get a complete turnaround in the dollar, and that would be, reasonable. But I'm going with weaker dollar until I'm shown I'm incorrect. On the daily chart for pound dollar, pause the video if you're not ready. All right, so I had a trend line here. It's a trend line phantom. The idea was we would see some kind of a range expansion. On Wednesday's midweek review, I said Thursday we would probably see a large range day down, and it was larger than all these days here. And at one point when it was down at the low, this was all bearish. So it opened here, traded down, and it traded into the bullish order block here. So it cleared up all the sell side liquidity in here. And I mentioned even on Wednesday's video, it doesn't have to be a down close. I'm anticipating a large range day on the expansion on the downside. And we might get some kind of a reaction and go higher after that. But I made very clear that I did not say it had to be a down close. We were looking for it to run down below this trend line. That's the nature of it. Now, in a perfect world, it would have ran below this low here. But it didn't quite get down there. But it met stiff support at the order block, which is fine. I'm going to get into this area here and justify why this level was even more significant. 1 hour chart on British pound versus US dollar. Pause the video if you're not ready. All right, so a whole lot of stuff going on here. Buy side liquidity pool here, clean highs. So that's the next draw on liquidity. This fair value gap you'll see when we go into the 15-minute time frame. And this gap here, I'll show you zoomed in that little area. I mentioned on the Friday daily log entry when I was doing the cable market, I mentioned that the chart at the time in that Friday video gave you the impression that it's a very thick black line that I'm drawing down there. And much like it looks like here, it looks like it's just one single thick, black line. And it's not, it's actually two levels, but it's simply because of all the range that's being shown here. You really can't see the tiny little range that it drew down to, okay, which will align with all this here as well. But we had a nice reaction here. It's created a huge buy side imbalance. If we continuously trade higher, this is indicative of really underlying bullishness and bearishness for dollar. So that's the only reason why I have it such a big bold, like a billboard on that, because this is a whole lot of action in here suggesting that, what we did down here may have been just taking everybody out that was looking to be long to capitalize on some, 200, 300, 400 point run higher. They have been removed from the game, so they don't get a chance to run for that goal. I'm going to drop down into the 15-minute time frame and outline all this here. But before I do that, that small little gap that I said that looked like a single line on the 18th, you can see right in here. That's that little gap. Okay, so go back into your charts. Right in here in January 18th. That's what you'll see with Forex.com's 1 hour chart on a British pound versus US dollar. You'll see that little gap right there. And you're thinking, serious, Michael? Like that's where it reached for? Well, it's just one thing. Okay, this is the discount array. In addition to now with what I'm going to show you here. So here's the 15-minute time frame, naked, doesn't have anything on it. If you're not ready, pause the video. All right, so we have an old low here. And I mentioned that we would see at the time on the 3rd that we would see the market roll over, go lower, and run out to sell side liquidity. So we knew that we were looking for prices to go lower and go below this low. Now the question I get, and this is what a lot of folks that troll me say, you're trying to tell me that this guy knows how far it's going to go down below an old low. Yeah, and I'm going to teach it to you right here. First things to consider is, yes, there's liquidity below this low. What kind of liquidity? It's going to be sell side liquidity, sell stops, okay? What's residing below this low is the protection mechanism for those individuals that tried to buy this and held on to it until here. So if it gets below this low, their idea is, I don't think it's a good idea to be holding this long. So I'm going to put a stop loss here below this low to protect me. And if it trades down there, I want to be taken out. That's the logic. Well, smart money, like we've been looking for lower prices. So every rally up, we would have been using that as a catalyst to go short, and then pair that up with willing sellers at a lower price to buy from, to cover or take partials on that short position. Below this low, what price level is significant below it? It's the 136 big figure. So that's a big round number, just like mid figure 50 level is, and the 20 level is an institutional level, and an 80 is an institutional level. So if we trade down below this low, it could trade to the big figure. Now, if it does trade to the big figure, there's always the likelihood it could trade down through the big figure. And the same thing I'm saying here for trading down to a big figure is the same when we're trading up to a big figure. So the rules I'm giving you here are just the same, just reversed, okay? So if we trade to the big figure, it could expand and reach for liquidity below that big round number. Large fund traders like to use these levels like this to put their stop loss below that. And that's what you saw here. This was a run on liquidity, not retail, but they're running on the fund level. So how do they run on the fund level? You find the big figure level, okay? And then what you do is you anticipate as much as 40 pips below or 40 pips above if it's reaching up to it. But you have to look at the levels like, okay, here's the big figure at 136 even. Then 10 pips below that is 135.90. I know, it's math. It's not staggering, Michael, but it's important that you understand what I'm saying here. If you go and graduated 10 pips below a big figure like this, next one is 20 pips below it is 135.80, and then 30 pips is 135.70. Look at this heavy line. Remember, it's not a single line. It's that fair value gap, and it's coupled with 30 pips below the big figure. Think about it now. We traded down into and ahead of this run here. This big pop here was what? The rate announcement for GBP. Oh. So what you're telling me, Michael, is we knew before the trading started last Sunday that there was going to be big volatility. I even said it in the video. Big volatility for GBP on the 4th at a specific time of day, 7 a.m. That's New York Open. Now, you know there's a big event likely to happen here. It's traded down below an old low and then graduated 10, 20, 30 pips into a discount array. Time is the first element. What is it? The time is when there's going to be big volatility in the day of the week that the economic calendar points to. So on the 4th, there was big movement expected on GBP. It's trading down below an old low where there's a discount, and it's lined up with 30 pips below an old low, 40 pips below an old low, I should say, and then 30 pips below the 136 big figure. So the rules are this. You can get big price reactions if we sweep big figures above or below 10, 20, 30 pips. In exaggerated price action, this could have went down 10 more pips, which would have been a 40 pip sweep below here, which would have been 135.60. And that's also likely. So if we were trying to trade down here with this idea, we had to consider an extra 10 pips in the idea where our stop loss would be. And then you catch a run like this, okay? Once that's happened, we're looking at this area right in here, and I'll show you what this is here. This is the heart of the teaching of this week. We trade up into that fair value gap that's over here that I'll teach you, retraces down into the imbalance here, and then starts filling in all the imbalances higher, another imbalance in here with sell side liquidity, trades into that, runs higher, small little fair value gap, runs into that, runs higher. There's been no stop loss runs since this one here. So we have a low here, it runs down below that. Why does it do that? This is something you want to have in your log, in your study journal. Sharp price runs are typically seen after a run on stops, both directions, higher or lower. So look at the dynamic price action here after we take out this low. See that? This low here is taken out here. We have a rally. We drift down, fill in the imbalance, and then it starts a rally. Short-term low here and a fair value gap. That could be your model. This could be your pattern, folks. Pay attention. Runs down, clears the sell side, rebalances, order block, optimal trade entry, bullish context, expansion higher is what we're looking for, and starts to run up. Same pattern here. Runs up. With the short-term bullishness that we're expecting on foreign currency and bearishness on the dollar, we would want to see this continuously try to drive higher. I don't want to touch this pair still, but I have to tell you what I see in the price action. All right, now it brings us to the close of this video and the lesson. This is that zoomed in area of that previous chart's fair value gap, and I'll show you again where it is over here on the 15-minute time frame on the 2nd of February, right in here. This is what I'm zoomed in on here. This one single candle, okay, this is redelivered rebalance. Listen, if we take this candle out of the equation, just imagine it never happened, and I'll explain why this is the case for this pattern. Take this candle completely out of the discussion. Say it doesn't exist, and we just had this candle, then this candle formed, and then this candle here formed. You could see logically that this would be the fair value gap, right? You see that? Watch closely. This candle has a tail. It trades down, clears liquidity, and then trades all the way back up here. So we traded down, gap down, came right back up. Is this efficient delivery? No, because it gapped down to get liquidity here and then closed back up here. So while it looks like it passed 2 times through this area on a down and then up move, it really wasn't efficiently delivered. But now watch what happens. The next day, we completely wash out the previous day's range. So it's redelivered rebalance. It jumped down there the first time and came back up. Now, you ever have, back in the old days, for you folks that are like 40 years old or so, maybe some of you still use them, but we used to have blinds, or shades they call them, on the windows, and it would be spring controlled, and they'd be rolled up when you're not using them, and then you want to close the shade for the night, or pull down your shade, they call it. You pull down the shade, or I guess it would be like a visor, keeping people from able to look into your home at nighttime. Well, the way you make them go up is you touch them and yank them a little bit down, to get the spring to release, and then you hold on to it as it goes up. Well, this is kind of like what's happening here. The shade was pulled down, but then when you let go, it went right back up real quick. So you want the shade closed, so it's going to have to get drawn down again, and it does it. So it's redelivered rebalance. You're getting what you wanted over here, but it didn't happen on a closing basis, and it didn't stay bearish. So all of this run in here is the inefficient price move. This looks scary to people that look at candlesticks, and that's why I laugh at people that try to make a big deal about specific patterns that they call in candlesticks. It has nothing to do, the algorithm has no idea with Steve Nielsen's candlesticks. Okay, no disrespect, but that's just the way it is, folks. It has nothing to do with it. All of these doji type candles and the logic behind it. I love doji candles because I know what retail thinks. They think they see all these turning points, and I love trading through them because that's really what's going to happen. Here, this sets the tone for if we have this big down close candle here. We don't necessarily need to be in this day, but if we see this candle here form, we know that this is eventually going to be a deferred rebalance. Okay, fair value gaps are deferred rebalance. This, in a lot of ways, is like an immediate rebalance, but the logic is redelivered rebalance. Again, you're not going to understand this the first time I give it to you. You're going to see more examples of this, and it'll make more sense as we go along. But for this week, I'm introducing redelivered rebalance, but it has to come with a run lower. Now, this could be obviously reversed. It could be a big wick and comes back down, and the next candle trades up through it, so it redelivered the rebalance, the very immediate next candle. Then you can frame out a fair value gap on that logic. And again, I'll teach you more as we go through, and you'll see many. In fact, you should go through your charts and see if you can find instances like this. Don't be discouraged if you can't, because you may not fully understand the logic here. But this is what I'm framing on as a fair value gap. I don't care about this tail. Tails to me and wicks are not important when they are inside of a narrative. It means absolutely nothing to me. This is more meaningful to me when this candle does this and the next candle only has a high here. My eye jumps to this, and I ignore this entire range. I care less. So this pattern will exist when you have a one-sidedness in the marketplace. When you are on side and you see the market wanting to reach a specific direction, and you see these instances like this, it helps you frame out levels that would be a fair value gap that nobody would necessarily expect, just because they don't see it like I'm explaining to you here. And it's not just a cherry-picked little thing. Go through your charts and you'll see lots of this stuff. It's there a lot. But it helps you ferret out areas where there's a whole lot of wicking and tails in the candles. I don't get confused by any of that. Like, I can cut right on through that if the logic is like it is here. And then when you have this and you go back and look at the previous chart, look at the sensitivity there. Boom. That is undeniable. And you can't really frame that on a fair value gap in the sense that the way I've taught it thus far. And that's what I mean by nobody knows what I'm teaching you yet. They can go out there and put it on their YouTube channel. They can go out here and make these little chat rooms up and talk about what's already happened and look smart. And it's, oh, you're teaching way better than ICT. It's right to the point. No, you're just pointing out the obvious. Trade it in the future. Call the week before it opens up. What's the narrative that's going to cause the week to perform a specific way with the fair value gaps? Because that's what I've been doing. They're not doing that, folks, because they can't. They're in here still taking notes. So with that, I'll wish you a very pleasant remainder of your Sunday, and I'll touch base with you obviously on the community tab on my YouTube channel throughout the week, and in Monday evening's daily log entry. Be safe.